Developing and investing in a new healthcare facility can be a great way to control the destiny of your practice, create tax benefits, and create ancillary revenue for your physician partnership. All that in mind, it's critical to understand the processes and potential pitfalls so that you can avoid them in a development process. In collaboration with Ted Baker, Senior Vice President of Cornerstone Companies, a nationally recognized developer and investor in medical facilities, will help shed light on some of the components of a development transaction to ensure you can create a successful outcome. Now that we've established what our goals are for a development project and who the players are that are involved, we're going to talk about what it really looks like when you put numbers to it. So Ted, can you tell us a little bit about the financial aspects and how to think about it from a development perspective?
Sure, Colin. And I think, even going before there, it's making sure your costs are accurate. So it's working with your designers, your architects, your contractor to understand, hey, what really amount of money is going into this particular project? And I think once you have that hammered down, or once you have that nailed down, then it ultimately comes to, what does this look like, or how does this pencil out from a return perspective? And from a developer, what we say is a yield. What yield or return are you going to put on that overall cost that's then going to drive rents, which ultimately affects the practice side of the business.
And so what I hear from that is, hey, we can generate probably a good return on investment for the physicians, those owning the building, but it's going to come at a cost, and probably that cost is in the form of some rent, right?
That's correct.
And so would you think about yield or return as the amount of rent you get in comparison to what the total cost of the project is?
So I think to your point, Colin, ultimately it starts with getting firm numbers that we can base an investment decision on. So understanding through your architects, your contractors, your engineers, do we have accurate estimates of what our project costs that then will in turn provide for a development pro forma, which helps understand the returns from a real estate perspective, and furthermore, ultimately the rent or costs that'll be associated with the operations of the practice.
And just to make sure I understand, is a development pro forma essentially a budget?
Correct, yes.
So it's important to work with your team members to establish and firm up the numbers involved in the process, right? And we have all these costs, whether it's hard or soft costs, project fees associated with the various professionals involved, and that all bakes into the development pro forma or budget.
That's correct.
And so how do we go about setting rents or determining our return on a project?
That's a great question, Colin. And really in today's environment, it's an exercise of balancing what rents we're going to set via a yield or what our real estate returns will be versus ultimately that rent's going to impact the P&L or the operations of the practice, and making sure you've got a balance there so the deal makes sense on both ends. And I think it's interestingly enough, as we've seen construction costs rise, really making sure you have a yield that works and rents that work has become ever more difficult.
That makes sense, because in order to generate a higher yield or return on your real estate investment, you can simply have higher rents. Would you agree?
Correct.
But the problem with that is that the higher rents could really impact your bottom line and the profitability of the practice. And then you probably also have to think about, at least from the perspective of costs of development being higher, making sure that our rents stay within the realm of fair market value. Because you're going to more than likely get a loan as part of this whole development process, which we'll talk about later. But when you're getting that loan, you're probably going to need to have an appraiser. And so you can't have rents that are too high because they won't check out from a market perspective. So it sounds like a lot of balance that's involved in that process.
Exactly. Really, the yield or the returns from the real estate perspective will drive the debt, will drive the value, will drive the overall success. But ultimately, to your point, you really have to balance from an operational perspective what you can handle or what you can maintain.
And to close it out, if we're talking about numbers and rate of return, it sounds so critical to have firmed up that budget ahead of time to make sure we know exactly what we're getting into with the project, what our capital outlay is going to be, and ultimately what our financial obligation is going to be on a going forward basis.
Exactly. It's better to know sooner than later so you can prep and plan for those next steps accordingly.
Great. Well, I appreciate it, Ted.
Yes, sir. Thank you.
Thanks.